This is the second lecture for this topic 9. Okay, in the previous lecture, you have seen or you have heard about the definition of equity, and then definition of shares, and then how to record the issuance of shares. Okay, so the thing is like this. When a company need capital or cash to do something, to run the business or to finance a new project or anything, the company can sell shares or issue shares. So when the company after the company sell shares, the company got the capital or cash from the investor or the shareholder. Okay, so that is the first thing that you have seen in the lecture 1. Now, after the company got the after the company sell shares to the people outside or external to the company, there are several things that can happen. Okay, these things are called subsequent movement of share capital. Things that can happen after the company sells its shares. Okay, so the first thing that can happen is right issue. Rights issue is the thing that the company can do. The thing is like this. Right issue is an issue of new shares to existing shareholders, giving them rights to subscribe to additional number of shares in proportion to their current shareholding. So see this like, it is aimed to raise capital without paying high cost of issuance. Normally offered at below market price, renounceable vs non-renounceable rights. Okay, right issue is something like this. Let's say a company has sell shares to the public, and then at one time the company can give the existing shareholder right to purchase specific amount of shares. For example, the company said, so for the existing shareholders, they are given right to purchase one additional share for every 2 shares that they have. So if a shareholder has 1,000 shares, the shareholder has the right to purchase additional 500 shares. So that is called right issue. So right issue is done by the company to get or to raise capital without paying high cost. Remember, if the company want to issue or to sell shares, the company has to pay certain cost. It is quite expensive. But if the company raise capital by doing right issue, it is cheaper, because if the company offers the right to the existing shareholder only, so it is cheaper. The process is easier. And also normally the right issue is offered at below market price. Okay, if the current market price of the share is 2 ringgit, when a company do a right issue, most of the time the company sell the right issue shares at a lower price, maybe 1 ringgit 80 cent or maybe 1 ringgit 70 cent. So the right issue is attractive to the existing shareholder. And okay, so and the right issue, it can be a renounceable or non-renounceable right. Okay, renounceable right means that the existing shareholder that receive the right or get the right to purchase additional shares can transfer the right to other people. Okay, that one is called renounceable right. If a company give non-renounceable right, it means that the shareholder that get the rights does not have or cannot transfer the right to other people. So that is what it means by renounceable and non-renounceable. So when a shareholder receive the right issue, the right issue means offer by the company to the existing shareholder to purchase additional right. So when a shareholder receive the right issue, the shareholder has three options. The shareholder can purchase all the shares offered, or the shareholder can sell the right to others. That is the case for renounceable right. If the offer is a non-renounceable right, then the shareholder cannot sell the right or transfer the right to others. And then or C, the existing shareholder can do nothing, just let the offer go. Let's say you are the existing shareholder. When you receive right issue from the company, so you have option. You can use the right to purchase additional shares, or you can transfer the right to other people, or you can just do nothing, let the offer go. Okay, so in Malaysia, right issue is governed by the Securities Commission. It means that a company that want to do right issue, they have to apply the procedure or permission from the Securities Commission. So if you have time, you can check in the textbook, example 6.9, right issue for no par value shares. So always refer to no par value shares because now in Malaysia we don't have par value anymore. Okay, this is the way to record the right issue transaction in the journal. Journal entries for right issue, no par value shares. So to record money received from applicants, you have to debit cash, credit application. To record amount due from underwriter, if any, debit receivable from underwriter, credit application. To record cash receipt from the underwriter, debit cash, credit receivable from underwriter. To record issuance of shares, debit application, credit share capital. I think I will give you an example later, sample question. So you can see how to record the transaction. Okay, this is another thing that can happen after a company sell their shares to the public. Okay, the first one that you just seen is the right issue. The second thing that the company can do after they sell shares to the public is to do or to give bonus issue. Okay, let's see the explanation. Bonus issue is an issue of new shares to existing shareholders without having them to pay for the shares. Okay, this is another thing compared to the right issue. Remember when I explained about right issue, the company give the existing shareholders the right to purchase additional shares. The right to purchase additional shares. So it means that if the shareholders want to purchase additional shares, they have to pay. Okay, now bonus issue is the company giving free shares to the existing shareholder. Okay, see the second point. An appropriation of profit or reserves to shareholders, especially when the company is unable to pay dividends in cash. Okay, this is done sometime in 1 year. The company does not have cash to give dividend. So the thing that the company can do is to bonus issue, to give bonus shares to the existing shareholders. So the existing shareholder are happy and they do not sell the shares. If if the existing shareholders sell the shares, so the share price will go down. So to avoid that, the company has no cash, but the company can give can do bonus issue to give bonus shares to the existing shareholders, so the shareholders will keep the shares. Other reasons are to defend against a takeover bid and to lower the current price of company shares with the expectation that it will make shares more tradable. Sometimes a company, after a company exists many years, the share price becomes very high. When the share price becomes very high, it is difficult for a new investor to purchase the shares. So to make the share actives, the company has to increase the number of shares in the market and also to decrease the price so that people are happy to purchase the shares, and maybe they will trade the shares. Trade means sell and purchase the shares. When the shares are active, then maybe it is good for the company. So other reasons are to defend against takeover bid. Sometimes to defend against the takeover bid. When the company do bonus issue, there are many shares in the market, so difficult for for anybody to take over the business because there are too many shares. Okay, and then both revenue and capital reserve can be used to issue bonus shares. In Malaysia, bonus issue is governed by Securities Commission. So if a company want to do bonus issue, the company has to make to get permission from the Securities Commission. So you check the example 611, bonus issue for no par shares, to see the example. So these are the journal entries for bonus issue. Okay, journal entries for bonus issue no par shares. First, to record bonus share derived from general reserve and retained earnings. So this is the way. So you credit the bonus issue, debit retained earnings, and debit general reserves. Retained earning and general reserve, they have credit balances. So when a company do bonus issue, the company uses the general reserve and retained earnings. So uses means the reserve and earnings becomes lower or decrease. So that's why you debit general reserves and retained earnings, and then you credit account bonus issue. To record the issuance of bonus shares, debit bonus share, credit share capital. Okay, I hope I can give you a sample question so that you can see how to record the transaction. Okay, this is number 3. Okay, this is the number 3 that can be done by a company after they sell shares to the market or to the people. Okay, this number 3 is called share buyback. Okay, share buyback. In number 1 and number 2, the company increase the number of shares in the market. Okay, the first one is the right issue. Right issue means the company give right to the existing shareholder to purchase new shares. If the existing shareholders use the right, then the number of the shares in the market will increase. Bonus issue also will increase the number of shares in the market. Share buyback will decrease or will reduce the number of shares of a company in the market. Okay, let's see what is a share buyback. A share buyback is a type of reduction of shares capital and hence equity. So let's say the situation is like this. There is a company, now the company has 2 million shares in the market, are traded in the market. When a company do a share buyback means the company buy back the shares that they have sold before. So let's say before they have sold 2 million shares in the market, now they have 2 million shares in the market. When they do share buyback, let's say they can purchase back 200,000 shares. So the number of shares after the share buyback is decreased. The number of shares in the market after the share buyback is decreased from 2 million becomes 180,000 shares only, because the company has purchased 200,000 or buy back 200,000 shares. Okay, that is the thing. When a company do share buyback, the thing that can happen is repayment of cash to shareholders in return for a reduced share capital, which was their investment in the company. Reasons for buyback are to increase the worth per share of the remaining shares and reduce the equity as a way of efficiently managing the surplus funds. Specified under the following laws and regulations. So this share buyback practice, they have to follow or comply with the section 67A Companies Act. Now we have a new one, regulation 18A Companies Regulations, chapter 12 Bursa Malaysia, listing requirements, etc. And when a company want to do a share buyback practice or to do share buyback, they need to fulfill the solvency requirements and need to follow the capital maintenance rule. Let's see, share buyback. Okay, so when you want to, okay, you have to see this example 6.13 to see how to record the share buyback of no par shares. To do the general entries, and also 6.15 subsequent treatments to share buyback, sale of treasury shares. Example 6.6 in the textbook. Okay, so that are the three things that a company can do after selling shares. This is another thing. Okay, this slide explains something about the dividend and reserves. Okay, dividends. Okay, I think you have heard about dividends before. Dividends, here it says that distribution of profits to shareholders of a company. So dividends means most of the time, if a company makes profit in 1 year, they want to share the profit with the shareholders. So they distribute the profit to the shareholders. The distribution of the profits is called paying dividends to the shareholders. Cash dividends from distributable reserves. Share dividends from other reserves. Dividends paid on equity instruments are treated as appropriation of profits. Dividend payment is not an expense. It is an appropriation of profits. It means that when a company gives dividend, it will decrease the or will reduce the retained earnings or the reserves. Dividend declared should not be treated as a liability until approved by AGM. So the practice of a company is like this: they will declare dividends. Okay, maybe the CEO or the directors will declare something like this. Okay, this year our company will pay 5 cent dividends for every share, or 30 cents dividend for every share. So they declare. When the dividend amount is declared, it should not be recorded as a liability. The dividend, okay, when the director or somebody inside the company declare they will pay dividend, you cannot record the declared amount in as a liability. You only have to record the declared amount after the amount has been approved by the annual general meeting of the company. Okay, when they declare, don't have to record. But when the amount is approved in the AGM, then you have to record it as a liability. When the amount is approved by the AGM of the company, the amount is an obligation for the company to pay. So when it is an obligation, it becomes a liability. There are two types of dividends: interim dividends and final dividends. Interim dividend is dividend that the company pay every quarter or every half year. That is called interim dividend. Final dividends are the dividends that a company pays at the end of the financial year. Okay, these are the journal entries related to the dividends and reserves. First one, declaration of dividends, no approval in AGM yet. It's not a liability, but only a contingent liability that needs to be disclosed in notes. So when somebody inside the company declare they will pay dividends this year, 5 cent or 10 cent or 30 cent or 1 ringgit, so that is a declaration only. You cannot record that as a liability yet. But when once the amount is approved in an AGM, it becomes a liability. When it is a liability, you have to record the liability. So see here, when the dividend is approved in an AGM, you have to record the liability. The liability is dividend payable. So you credit account dividend payable, and then this one you have to memorize. You debit account dividend declared. Okay, account dividend declared is a temporary account. And then when the company pay the dividend, so this is the way to record that. When the company pay the dividend, you credit cash and debit dividend payable. Okay, credit cash because when the company pay dividend, cash goes out. So you credit account cash, and then the liability dividend payable has decreased. So that's why you debit account dividend payable. Okay, if a company pays interim dividend, how to record that? So interim dividend is very simple. You debit account interim dividends, you credit account cash. Okay. Dividend declared and the interim dividends accounts are temporary accounts. So remember always, dividend declared and interim dividends account are temporary. At the end of the year, you have to close this account to retain earnings. So at the end of the year, you debit return earnings, you credit dividend declared and interim dividend. So this is the way to close the account. So you don't have to show dividend declared and interim dividends account in the balance sheet or income statement. No, because you have to close the account at the end of the year by crediting the account and debit account retain earnings. Okay, these are reserves. There are two types of reserve. Retained earnings, general reserve, sinking fund reserve, share premium reserve, capital redemption reserve, asset revaluation reserve. So these are the types of reserves. So let's see what is the summary for this chapter, for this topic. So equity, the summary is equity represents net asset or the residual interest in asset of the company after deducting all of its liabilities. So the simple definition of equity is asset minus liabilities. Second thing is issuance and movements in equity are governed by laws and accounting standards. Okay, easy to understand this one. It means that if you have a company or you work in a company, when you issue shares or sell shares to the public, you have to follow certain laws and regulation, and you have to get permission from somebody, something. maybe Securities Commission most of the time. And also after you sell the shares, when you want to do right issue or bonus issue or share buyback, also you have to get permission or to follow regulation made by the government. Okay, point number three, recognition, measurement, presentation, and disclosure of share capital and reserves must follow the substance of the items as equities rather than their forms. So if the item is capital, you have to show it as capital. If the item is liability, like bond and debenture, you have to show it as liabilities. Thank you very much. This is the end of the lecture. You can communicate with me in the comment section.